We've seen two unwinds of the extremely crowded tech trade of late, the rotation into small caps and the unraveling of the yen carry trade after the Bank of Japan announced that surprise rate hike. Markets shaking those off. But my next guest says a third unwind could be in the works as major retailers start reporting this week. And he's talking about the consumer. Let's bring in Travis McCourt, institutional equity strategist at Raymond James. And I don't normally think about the consumer as a top level kind of markets concern, Travis. But to your point, if Walmart reports a miss, I don't know, is it game over?
Yeah, I don't think they will. But the high end of the consumers is really pulling the weight of a lot of the economy right now. And so, we've made it so far through the rate hiking cycle. Inflation's clearly come down. Steve mentioned before, we're likely to see rates get lowered. And I think the key thing now is spending going to hold in there as they lower rates, or has the Fed been too tight for too long? And we're probably going to get that answer in the next 4 or 5 months. And in August, these reports are pretty important, especially the real-time data as it relates to rates coming down the last few weeks. If we see real-time data at some of the home improvement retailers pick up and mortgage applications pick up, that's a pretty good indication.
Right, and we saw Home Depot's results where, they said they expect comps to be lower this year, but the stock is hanging in there. It's certainly better than feared. Walmart, Target, these are more bellwethers maybe for consumer spending, broadly speaking. But even if there's trouble right now, I think people are really going to be looking to the labor market for confirmation of whether we're slowing or not. We can start getting some choppiness, and it would be expected as excess savings and all of that starts to run out. But it can still keep going as long as we see hiring.
Yeah, I think the net of it is we're at a pretty optimal economy. We're at full employment or something very close to it. The Fed has completed its rate hiking cycle, starting to ease. Things don't get materially better from here. I think a soft landing is things can stay this good for longer. And sometimes that lasts a couple of months, and sometimes that can last a few years. But it's not surprising when we get markets, when we're full employment like this, to get really choppy, as they have been in the last month or two, because investors are always going to believe that there's a potential recession around the corner whenever we're at full employment.
So for those who are rotating into small caps, saying that growth is broadening out, it's not going to be like the past 12 months. It's going to be more evenly spread. Small caps, value stocks, those kinds of areas can benefit. Would you be in that trade, or you sound to me much more cautious about stocks overall here?
I'm a little cautious. I think it's fair to say if we have a true soft landing, small caps are going to do fine from here. But we've come a long way since October of last year. So I think, in October of last year, it really didn't matter, just throw a dart. As long as we weren't having a steep recession, pretty much everything was going to go up, including small caps. Now I think it's a little more nuanced. We're not really pricing in much of a recession scenario out there. So if we do happen to slip into recession, we've seen this market overreact 8 different ways over the last 2 years. Probably overreact to a recession too. So I think, whenever you're in a full employment economy, it warrants some caution. Not that things will get worse from here, but they can't get much better.
What do you do? Do you buy gold? Do you buy bonds?
generally,
do you load up on munis?
Yeah. So generally in these markets, what tends to outperform is the more defensive, interest rate sensitive sectors. So a lot of the areas that we've seen finally start to outperform over the last month or so, real estate, staples, healthcare, utilities, the things that nobody really likes to own. But generally,
the bond-like plays.
Yeah. That's right. What the math says outperforms late in the economic cycle.